Hello and welcome back to The Note. We've had a dramatic and confusing day on world markets, and I think the key point to get across is that there has been a very significant shift in the market's expectations on when we will finally get a rate rise from the Federal Reserve. This chart shows it as clearly as anything. It's derived by Bloomberg from the Fed funds futures market, where people place bets on where the Fed funds rate is going to go in future. And you can see that it now suggests that there is more than a 50% chance that the rate will still be virtually zero even after March's meeting of the Federal Open Market Committee. Bear in mind that at the beginning of this year that chance was put at virtually zero, and see how sharply that expectation, those odds that the Fed stays stuck at zero for a longer time, see how sharply those expectations have risen. Now that's partly because of incoming macro data, starting with the September payrolls data from a few weeks ago, the latest data we've had today on Chinese factory prices, Chinese imports, US retail sales, all somewhat gloomier, somewhat slower than had been hoped. It's primarily, however, because there appears to be dissent within the Fed. We've had speeches by more than one Fed governor now suggesting that they do not think it would be a good idea to raise rates this year. That mere fact that it contradicts the message that we'd been receiving from the chair, Janet Yellen, and her deputy, Stan Fisher, suggests dissension within the Fed, and that connotes alarm for the markets. Now, the immediate impact of the shift in perceptions on the Fed is that you've seen the dollar weaken very significantly against a range of other currencies. You've also seen bond yields come down. The 10-year is back below 2%. It's at its lowest since about April. Now, moving on to the stock market, we are, of course, in the middle of earnings season, and we had an extremely ugly surprise today from Walmart. You can see how ugly that is from this chart here. We had a profits warning. They're expecting a reduction in earnings per share for next year, and that's caused Walmart's shares to drop 10% in a matter of minutes. Now, that was obviously an extreme example, but we've had a number of companies announcing very disappointing revenues, in large part obviously because of the strong dollar, but companies with sharp revenue falls would include CSX, Alcoa, Johnson & Johnson, and JP Morgan. And in all cases, that has been troublesome for the stock, even in the cases where they've tried to ameliorate that with a stock buyback. At this point, the markets want the comfort of seeing that companies actually are raising cash and are not too concerned, or in fact would prefer not to see them using debt to fund buybacks. Now, one final chart might be useful at this point. Walmart tends to be a contrarian indicator for the rest of the market. You can tell why Walmart is somewhat of a boring story. When things are going well, there are other things that are more exciting than Walmart. When things are going badly, it holds its value in the way that others don't. When, therefore, Walmart significantly underperforms, that tends to be an indicator of a coming peak, and vice versa. And as you can see, Walmart's underperformance is now right down to the level that we saw at the peak before the crash of 2007 and 2008. There are different circumstances driving it, but when there is this kind of pain for Walmart, that can easily tend to imply that there is pain for the rest of the market coming that has not yet been priced in. As for the overall stock market today, it was down, but not down by very much. You have the countermanding effects of the disappointing earnings numbers that we've had so far, with the prospect of lower rates for longer that should help stock markets. How those play out over the next few months will be fascinating to see. The next key point of information, apart from the next round of earnings, will be US inflation data.